Here's what's going on, folks. It's the slow dissolution of the value trade, the early cycle trade, the reopening trade, whatever you want to call it. Look at the sectors today. The market is telling you what they're doing right now. So there you see banks down, energy down, industrials, materials down, tech not down much. OK, that's the reopening trade. That's the value trade. That's the cyclical trade. Again, a lot of different words, but that's what it is. So take a look at what's been going on this week with commodity stocks. By the way, NVIDIA, a lot of the semis are up. AMD's up. Amazon's on the upside here. We've talked about the dissolution of the commodity trade. This is the reopening trade, the cyclical trade, the value trade here. Copper stocks, steel stocks, gold mining stocks, agricultural futures, which you can own in ETFs now. It's really remarkable how they've developed these ETFs, and oil services here. There it is. There's the cyclical trade here starting to come a bit unwound. Why is it coming unwound? So here's where we are right now. The big problem, and Scott mentioned the confusion, and he's right. Where are we in the economic cycle? Is it early cycle, mid cycle, late cycle? What the heck is going on? This is why you're getting these crazy moves in sectors all throughout the days these days. Markets are more worried about weaker growth now than they are about inflation. At least the Fed is clearing up some of the problems, despite the confusion they caused in the past about this. So the Fed signals are implying we are really in a mid-cycle. What's that? What's a mid-cycle? Well, the early cycle has been buy the value stocks, buy cyclical stocks. We're past that now. Mid-cycle is where you still have growth in earnings, still strong, but they're starting to decelerate. And this is the big debate about the third and fourth quarter. Still strong, but starting to decelerate. Interest rates still are relatively low. And you would traditionally buy tech stocks, which, by the way, is exactly what they're doing this week. There's some debate. Some of the more bearish people think we're in a late cycle or maybe heading into it in the next couple of quarters. Late cycle would imply higher rates, higher inflation, higher PE ratios. And in that situation, you buy defensive stocks like consumer staples. We're not there yet, but there are some bears out there that are arguing we're heading in that direction. The only thing that's good that's happened this week is the Fed is trying to hold the market's hand, not just on inflation, but on where we are in the economic cycle. And you can see the market reaction. So the big trade all this year, buy value, buy small cap. What's been the biggest move up? Small cap value. That's been the biggest trade this year. What's down the most this week? Small cap value. They're unwinding the early cycle growth, cyclical trade. Value also starting to unwind a little bit. What's been doing a little bit better this week? All right, not a lot, but certainly outperforming is growth. We're going from early cycle. The market now believes we're going from early cycle to at least into the mid-cycle, and some people want to debate when we're going to go into later cycle. So I know, Scott, you've been absolutely right on this. The market's been confused, and the only thing good that the Federal Reserve has done so far this week is at least held their hand and give some idea about, okay, we have to make a decision where we are in the cycle, and the market is deciding we're kind of in the middle of the cycle. Let's buy tech. Let's sell some of that cyclical stuff. That's what's going on right now. Scott, back to you.
Bob, we appreciate
that
it.
That is perfect.
Yeah, Kramer was nodding his head,
that is
Bob.
a perfect
as you were
analysis.
giving your report, he really thinks you nailed it, right?
Just perfect. I'm talking about perfect.
Perfect. Well, better
you can see the market. You know what you do with the market, Jim?
Perfect.
What you do with the market, Jim, as you do all the time, is you don't overlay your ideology on it. You look at the market, you see what are the facts, what is actually moving in the market, and then you come up with an idea. What accounts for what the market is doing?
Exactly.
You don't do it the other way around.
No, exactly.
Shepard Smith here. Thanks for watching CNBC on YouTube.